Hello everyone. Today we'll be exploring some of the most important and emerging areas in the field of accounting that go beyond traditional financial statements. Green accounting, human resource accounting, inflation accounting, carbon accounting, forensic accounting. Together, these branches show how accounting is no longer limited to number alone, but is evolving into a tool for sustainability, transparency, and accountability in modern business. I'm Harini. I'm going to tell you all about green accounting. Green accounting is an approach where we include environmental cost along with financial data, unlike traditional accounting that focuses only on profits and GDP. It also considers resource depletion and ecological impact. In simple terms, it gives us the complete picture of growth by linking prosperity with long term environment well being. Green accounting helps decision makers look beyond money. For example, a factory includes pollution control costs while planning, or governments promote solar energy instead of coal. It also adjusts measures like GDP by including forest loss, and businesses become more responsible by reporting waste and recycling. So it adds real meaning to our economic progress. The role of green accounting is to guide both governments and businesses in making sustainable decisions, to encourage careful use of resources, and to improve accountability. Its main objectives are to measure true economic welfare, promote sustainable development, support eco friendly policies, and motivate conservation of our natural resources. Even though it is useful, green accounting faces some challenges. Let us know about it. It is difficult to put money value on things like clean air and biodiversity. Many countries also lack reliable environmental data. There are no universal methods for measurement. Businesses often focus on short term profits, and implementation can be costly. These issues limit its wider option. Going forward, green accounting should be aligned with the UN Sustainable Development Goals. We can use AI and big data for accurate tracking of emissions and resource use. It should move beyond being just a compliance requirement and become a tool for innovation and competitiveness. Ultimately, it is essential to achieve sustainable, inclusive growth for both present and future generations. To conclude, green accounting is not just about numbers, it is about valuing our environment along with our economy. It helps us see the real cost of growth and ensures that development today does not harm the needs of tomorrow. In short, it is step towards making finance and sustainability go hand in hand. Thank you.
I'm Vishalini. My topic is human resource accounting. Normally, in accounting, we record things like land, buildings, and missions. But employees who actually drive the company's growth are not shown in the balance sheet. HRA try to solve this. It is the process of measuring and reporting the value of employees in monetary terms. Instead of calling employees expenses, HRA treat them as assets who generate future income. The objectives of human resource accounting are simple yet vital. It provides data for better managerial decisions, support recruitment and retention measures, measures employee efficiency and their contribution to income, and evaluates the return on investment in people. Most importantly, it communicates the real value of human resources to the both organization and society. There are two broad types of methods: cost based and value based. In cost based methods, the historical cost method records actual cost of hiring and training. The replacement cost method shows how much it would cost to replace an employee today. The opportunity cost method values employees based on their alternative use in the company. The standard cost method fixes as a cost per grade of employee. The total cost method looks at total spending on training and development. In value based methods, the present value of future earnings calculate today's values of employees' future salaries. The net benefit method considers benefit earned after cost. The capitalization of super profits allocates part of extra profits to employees. And total payment method include all direct and indirect payments given to employees. The importance of human resource accounting. First, it shows employees' contribution to profits, which is usually hidden. Second, it encourages investment in training and development. Third, it boosts morale because employees feel valued as assets. It also helps managers in planning and making HR policies with real data. And for outsiders, it provides transparency, showing that the people are main strength of the company. Overall, it links HR practices with financial performance. Benefits and limitations of human resource accounting. The benefits are it helps in better budgeting and decision making. It leads to improved HR policies. It helps to motivate and retain employees. It is useful in mergers and acquisitions by adding human capital value, and it supports succession planning for the future. The limitations are there is no single universal method, so results differ. It is subjective because employees' value changes with skills or health. It is not recognized under any accounting standards like AS or IFRS. And finally, there are ethical concerns because putting a price on a humans or can be controversial. To sum up, human resource accounting shows that while missions depreciate, people appreciate, and human capital is the truly most valuable asset of the organization. Thank you.
I'm Shruti, and now let's see about inflation accounting. In accounting, we record transaction in monetary terms under the money measurement concept, usually at historical cost. This assumes that the value of money is stable. However, in times of inflation, money loses value. As a result, historical cost-based statements becomes misleading. For example, fixed assets are shown at old purchase prices, depreciation is charged on outdated costs, profits appear higher than they really are. This can lead to wrong decisions, erosion of capital, and even unfair dividend distribution. Clearly, historical accounting fails to reflect the true financial position during inflation. This is where inflation accounting comes in. It adjusts accounts to reflect current price levels, ensuring that profits, assets, and liabilities values. The American Institute of Certified Public Accountants defines it as a system of recording events in terms of current costs. Now let's look at the methods of inflation accounting. The first method is the current purchase fee. Under this, all items in the accounts are adjusted using a general price index, such as the wholesale price index in India. The idea is to maintain the purchasing power of shareholders' funds. For example, if inflation is 10%, values are restated using a conversion factor. This method is simple, but it does not consider changes in the price of individual assets. The second method is the current cost accounting method, or CCA. Unlike CPP, this focuses on the current replacement costs of each specific asset or liability. For instance, fixed assets are valued at how much it would cost to replace them today. Inventories are valued at current replacement prices, and depreciation is charged on these updated values. This gives a much more realistic picture of business operations, especially for decision making. Finally, there is the hybrid method, which combines both CPP and CCA. It uses the general price index for monetary items and specific indices for non-monetary assets. This way, it tries to overcome the limitations of each method. Now let's consider the advantages. Inflation accounting presents the true financial position of a company. It corrects overstated profits and ensures that dividends are paid only out of real earnings, not out of capital. It protects shareholders' funds from erosion and maintains the purchasing power of capital. It also helps investors and creditors by giving them reliable information and aids managers by providing realistic data for decision making, planning, and control. At the same time, there are limitations. Inflation accounting is often complex and time consuming as it requires frequent adjustments based on changing indices. It may involve subjectivity in choosing price indices or valuation methods. Comparisons between firms can become difficult if different methods are applied. Moreover, it is not legally accepted for tax purposes in most countries, which limits its practical use. To conclude, inflation distorts traditional accounting, but inflation accounting provides a more realistic and fair representation of financial statements. By using methods like CPP, CCA, or the hybrid approach, businesses can show true profits, protect capital, and make better decisions. While it has some drawbacks, its importance in an inflationary environment cannot be ignored. Thank you.
Hi, my name is Manas. Today I'll be presenting on the topic of carbon accounting, a topic that lies at the heart of modern environmental responsibility and climate action. Understanding how we measure and manage our greenhouse gas emissions is crucial not just for corporations, but for governments, communities, and the planet as a whole. Carbon accounting is a structured process of measuring, reporting, and managing greenhouse gas emissions, mostly carbon dioxide, from all kinds of activities, products, businesses, and entire economies. Think of it as similar to financial accounting, but instead of tracking money, carbon accounting tracks the climate impact. Why does this matter, you say? Because having precise data on emissions is essential for making smart decisions to meet climate targets, comply with environmental regulations, and to demonstrate that we're serious about sustainability. Now, at the core of carbon accounting is the idea of the carbon footprint. This represents the total greenhouse gases generated, measured in carbon dioxide equivalents. To make tracking easier, emissions are split into three scopes. The first, direct emissions from sources directly owned or controlled, like company vehicles or on-site fuel combustion. Then comes indirect emissions from purchased electricity, steam, heating, and cooling, and all other indirect emissions, including supply chains, business travel, waste, products in use, and end of life treatment. Carbon accounting isn't random. It relies on strict science-based standards like the Greenhouse Gas Protocol, that is GGP, and ISO 14064, ensuring that results are consistent and credible. The process starts by gathering lots of data from fuel bills, energy purchases, travel records, and waste management. With all this data, emission factors are used to calculate the actual greenhouse gases released. Today, specialized software tools automate calculations and reporting, helping organizations analyze trends and forecast the impact of different reduction strategies. Many companies also use third-party auditors to verify the carbon inventories. This builds trust and meets regularity needs. Now, carbon accounting offers huge benefits. It helps organizations identify emission hotspots, set achievable reduction targets, comply with regulations, and increase brand value by proving commitment to environmental responsibility. But there are challenges too. Reliable data requires careful collection and coordination, which involve many suppliers and partners. The process can be complex and sometimes expensive, needing skilled staff and robust technology. Plus, the rules and expectations around climate action are always evolving, so it's important to regularly review and improve the carbon accounting approach. After reducing emissions as far as possible, organizations can use carbon offsetting to balance out what remains. This means funding verified projects like tree planting, renewable energy, or methane capture that reduce greenhouse gases elsewhere, outside your business. Offsetting should never be an excuse to avoid reductions, it's the last step, not the first. Looking ahead, success in carbon accounting depends on prioritizing direct emission cuts, only using high quality offsets, and being transparent with data for public and stakeholder confidence. In summary, carbon accounting is more than just numbers. It's a structured framework that transforms how organizations understand and fight their environmental impact. By using clear concepts, trusted methods, and ongoing improvement, carbon accounting isn't just about reporting, it actively drives climate action, helping us build a more sustainable future for everyone. Thank you.
Forensic accounting. Forensic accounting is a combination of accounting, auditing, and investigating skills. It goes beyond just preparing accounts. It's because of uncovering the truth behind the financial records. The main purpose of it is to examine the financial information in such a way that they can stand in a court and help resolve disputes or frauds. Today, financial crimes are on the rise from corporate frauds to money laundering. Regular audits are not always designed to detect international fraud. There are ways where forensic accounting steps in. It provides courts with regulators with strong evidence based analysis to uncover manipulation and ensure justice. There are few key areas where forensic accounting occurs. Forensic accounting works across multiple areas. They investigate frauds, detect money laundering, trace hidden assets, provide litigation support, and ensures insurance claims. Their role is not limited to companies, even governments and individuals rely on them to protect their financial integrity. These are the process for forensic accounting. The forensic accounting process usually has four stages. First comes investigation, where financial documents and transactions are examined, then analysis to identify unusual patterns of frauds. Then comes reporting, where clear and factual findings are presented. Finally, forensic accounts may provide expert testimony in court to explain their results. There are few tools and techniques to do this effectively. Forensic accounts use modern tools. They analyze big sets of data. They use digital forensic to track online fraud and review these documents thoroughly and conduct interviews. These techniques make sure there are no suspicious transactions or hidden details which are missed. There is a simple case example. The well known case involved corporate fraud where forensic accounts traced hidden bank accounts the top executive had used to manipulate frauds. By piercing together finance evidence, they were able to expose the truth and bring justice. Such examples show how vital the profession is in safeguarding the business and investors. There are few future trends. Looking forward to this, forensic accounts will grow even more with cybercrime and cryptocurrency becoming common. New challenges will increase using artificial intelligence and big data to detect frauds faster. This makes it a dynamic, future ready profession. Thank you.